With this short video, we're going to examine two defense companies that we believe are being fairly unpunished today by the Mr. Market based solely on fear. Our first example is L3 Communications. This company went public in 1998. We want you to notice by the orange line here that they've had a very consistent string of earnings growth. Year after year, earnings have increased from 66 cents a share to 91 cents a share to $1.22 a share and so on, where they earned $8.45 a share in 2010 and are expected to earn $8.81 a share. So earnings growth has been very consistent, and the market has always priced them at around 19 times earnings. But you can see since the Great Recession of 2008, the share price has inexplicably fallen, even though earnings have continued to hold up. We're going to shorten this now to just the recessionary years to kind of focus on this a little more. And you'll notice in 07, 08, 09, and up to, currently in 2011, earnings growth did slow down to about 11.5%, but that's still a very high rate of earnings growth, and it doesn't justify the stock price falling so precipitously, mostly on the fear of defense spending cuts and, of course, coming into the recession. So now we see an extremely high quality company that can be bought at a PE ratio of 7.3, which is less than half the average of the S&P 500 over the last 100 years or so. It has a 2.8% dividend yield, and as we're going to now look, is expected to grow rather nicely in the future, although not perhaps at the rate it has historically. But before we do that, let's go back and let's go now and look at the long-term track record that this company has achieved, even at today's excessively low valuation. A $100,000 investment in May of 1998 when the company went public would have grown to $455,509. That's an 11.9% closing annualized rate of return, or capital appreciation, if you will. Add in $48,000 in dividends that started with 2004 where they first paid a dividend. You can see their dividends increased every year, and you get a rate of return of 12.7% on an extremely high quality defense contractor that's currently being traded at half of what we would consider to be its intrinsic value. If you look at the consensus of 19 analysts reporting to Capital IQ, we discover that the company is expected to grow at 7% a year. That's significantly slower than they have historically over the last 14 plus years, or even over the last 5 years since the Great Recession. So we consider this to be a very conservative number. But if you applied a 15 multiple to that 7% growth rate, and their current level of earnings, you would get a stock value of around $130 a share. If they grew earnings at 7% a year and were able to increase their earnings to over $11 a share by year-end 2016, that would imply a $173 plus value. That comes out to a 23.4% compounded rate of return on an extremely high quality defense company that can be bought at an excessively low valuation. Our second example looks at General Dynamics, a perhaps more popular or famous defense company. As you can see, there's been a long-term relationship between earnings, the orange line here, and stock price, the black line. They've correlated and tracked, very, very closely until we got to the Great Recession. Earnings continued to grow, but once again, we saw this precipitous drop in stock prices, which we believe is primarily a function of fear, not fact, as we indicated in the article. General Dynamics today trades at 8.8 times earnings, has a 3% dividend yield based on an earnings growth rate of 13.6%. If you look at that over just the recessionary years, since the Great Recession, we find that the earnings growth has still averaged over 11% a year. So even though there was the Great Recession, earnings did, slow down a little. They were still extremely strong relative to what happened to a lot of companies, but yet General Dynamics saw their stock price cut in half. Even at today's very low valuation, when you look at the long-term track record, you see that this company has still achieved a 9% compounded rate of return. Add in dividends, and that rate goes to over 10%. But the point is, at today's low valuation of 8 times earnings, you can buy a stock today at around $63 a share that we believe has an intrinsic value of $108 a share and a future intrinsic value of $156 a share. So over time, we expect to get a price earnings ratio expansion. We would expect that sometime in the future the PE would go up to the 15 multiple as depicted by this orange line. That would give us the potential for a 21% 8% rate of return on an extremely high quality defense contractor with a very strong balance sheet, only 15% debt, and yet, you can buy this stock at one of the lowest multiples that we've seen in, in its long-term history. Quality dividend paying stocks are on sale, and it's only fear, in our opinion, that is creating the opportunity. But rather than avoid names like this, we believe that investors should be embracing the opportunities. As Warren Buffett said, fear is the foe of the fundamentalist. And the bottom line is, fear is the foe of the faddist, but the friend of the fundamentalist. We believe fear is our friend today, and stocks are on sale.